Teresa.
Great. Hi, everybody. I'm Teresa Young. I'm with the Kohala Center. I do co-op development. And so I'm so thrilled that we've had so many people interested in this 4-part series. Today is our fourth part series, and growing Hawaii co-ops together, because really our strength is in our members, that we think. So first of all, I want to thank everyone who has participated, but I really want to put a shout out to Donna and Kenta with the Ulu Co-op for putting so much time and effort and putting this on. It's like co-ops need champions, and they have them. The Ulu Co-op has several champions, which I think is really cool. So to get going on this, I'm really excited. Today's workshop's going to be on financials and fundraising for co-ops. It seems to be like one of the most difficult and challenging pieces to understand and work with. And so we have a couple amazing speakers today that I'm really grateful that have come into my life and in the lives of the Hawaii co-ops. And so I'm gonna tell a little story about how I met them to just get us going, because you know, it's like co-ops are all about like relationships and kind of supporting each other and working cooperatively together. And as you know, really it's like almost because of the Ulu Co-op, I really needed this kind of expertise that we don't really necessarily have in Hawaii. People who are lawyers and accountants. So I got to meet both of these speakers at the same conference. I actually went looking to establish some relationships with some lawyers and accountants who really understand co-ops. So I got to meet, first of all, I met Josh Bakke. Is that how you say it? Bakke?
Yeah.
Anyway, he sat with me in the back of the room, and it was so great. We connected because we were both. So I went to this conference of co-op, accountant, and attorneys. So I'm neither an accountant or attorney. I just do co-op development. So I was a little out of place, and Josh was a little out of place because he focuses on ag co-ops. And this conference had all kinds of stuff that had housing co-ops and some worker co-ops. And so there was a lot of different subject matter. So we started talking about ag co-ops in Hawaii. And so we made a really great connection there. And Josh didn't even realize that I also met Dave at that conference, but Dave was sitting in the front of the room, but he also was a presenter. So I recognized him as an attorney who knew a lot about co-ops. And so I kind of had my eye on him in the conference, and I noticed that he was so busy constantly. Like whenever there's a break, he'd be out in the hall on his phone. I mean, he worked continuously. And I was like, wow, that guy, you know, you get stuff done when there's a busy guy around because they're just constantly doing stuff. So I introduced myself during the conference and talked to him a little bit and tried to make a connection. But really what happened was we ended up staying at the same hotel because the conference was at a college. And I think we might have been the only two at that hotel. I don't know. But I went out because I'd never been into this city, Cincinnati, before. And I walked around at that, you know, I walked around where they have that big fountain that you see on Married with Children. And so anyway, coming back into the hotel, the reason it was so cheap is because they were under renovation and I couldn't find my way in. But there was a door that went into the bar. So I walked into the bar pretty much the same time Dave did. And I noticed and I said, hi. And so then I just sat down and we started talking, and I think I had a beer and some dinner, and we talked for an hour, and he was waiting for his kids. And so, so it was so great. It was just like this really deep, heartfelt connection. So I've been able in the meantime to introduce both of these guys to Donna at the Ulu Co-op, and they have been working with her on their own and establishing their own relationship. So again, I'm so grateful, and that relationships make co-ops work, really. And that we're all in a kind of a let's work together kind of movement to begin with. So
I have to add to that, Teresa.
Sure, go ahead.
My
my two children who were living in that there met me and they said, we'll meet you in the bar. And they were quite impressed that when they came into the bar, I was sitting with a woman from Hawaii chatting about co-ops.
Yeah. Oh, that's fun. So yeah, it was a great meeting. And so anyway, I'm very happy to present these guys today. So Dave Swanson is partnered with Dorsey Whitney. It's a big law firm, and he specializes in co-ops and knows a lot about them. And Josh, like I said, Bakke, he's a CPA with Moss Adams who really focuses on agricultural co-ops. So between these two, they're going to talk about, you know, capital and how to raise it, and taxes within a co-op. And it's like, you know, how do you use like your retained earnings and how do you give them back? And it's like, how do you raise money and where do the securities, you know, what is it about securities and co-ops? And so they've just got a ton of information. So I'm going to stop talking and turn this over to them. But before I do, I want to just, because if we don't have time for it afterwards, I want to just make sure I say it beforehand, is that we've got recordings of all 4 of these workshops that are going to be on the Ulu Co-op website. So people will have access to this information even after these workshops. So without further ado, I'm going to turn this over to Josh. So thanks again, you guys.
Thanks for having us.
Yeah, thanks for having us. Thanks for the introduction too. I think that conference was like 4 years ago at this point. So we've had a lot of time pass since that happened. Well, so like Teresa said, I'm a senior manager at Moss Adams, and I work in our agribusiness practice. I specialize in consulting for agricultural cooperatives. So most of who I work with is marketing and supply cooperatives that sell anything that comes out of the ground on the West Coast. We also, the practice has grown to, we're not only ag focused. We do work for some grocery co-ops and some worker-owned co-ops, and also recently in real exciting development, but some organizations have developed entities that exist on the chain, but on blockchain, and have decided to use the co-op model as their legal entity to pay tax. So co-ops aren't just for farmers. They get used in pretty unique ways, and so I'm excited to get to teaching you a little bit about them today. Dave, did you want to introduce yourself, or you want me to jump in?
I will just say a few things. I really appreciate being here. I have been lucky enough to work almost exclusively with co-ops as a lawyer for over 40 years. And it started for me in Chicago, and I got a job in a law firm. I had no idea what a co-op was, even though I grew up in Minnesota where there's co-ops all over the place. And so I'm working on, it was for real electric co-ops for financing. And I thought, wow, what's this co-op thing? And I started looking into it and realizing that it was a pretty interesting thing. And then after a couple of years, I moved up to Minneapolis, which has a lot of co-op activity and a lot of professionals in the co-op world, and got it in a law firm that worked primarily with co-ops. And so for almost this whole time, that's all I've done. And they're in all kinds of industries. And they're from really big, like Land O'Lakes, to really small, just a handful of people starting up, and all over the country.
Thanks, Dave. I'm going to jump into these slides. It'll be a lot more entertaining if while we're going through these, if anybody has questions, you want to unmute yourself and ask, please feel free. We'll have a little bit of time at the end for Q&A, but don't feel like you can't interrupt while we're on topic and ask questions. So co-ops are unique to other entity types, and they can face some special challenges when it's time to raise money. They are not traditional in a lot of different ways, but a co-op's obligation to return its profits to its members can cause a lot of confusion when you go to a bank and ask for money, and they say, well, you don't really have net income year to year. How are you going to service this debt? How are you going to grow? Things like that. And so co-ops and their members have had to get pretty creative over the years. We're going to talk about a lot of ways that co-ops can raise money internally from their patrons. But it doesn't mean that there aren't other options. At the end of this, we'll talk a little bit about preferred stock. But when I was going through this before the presentation started today, I realized that we don't have slides in here that talk about the farm credit, the cooperative banking system, and banks like Farm Credit and CoBank that exist solely to lend money to cooperatives. So if you want to go to a regular bank and ask for co-op financing, it's a little bit more difficult than going to one of these co-op banks to explain your business model and to get financing. They've been around for a long time, and just be aware that they exist and that there is bank financing available to co-ops. So when you're looking for money in a co-op, where is it going to come from? You've got a huge base of members that the co-op exists for, that are doing business through the co-op, and that money is available to you. We're going to talk about lots of different ways. The profits of a co-op are generally going to be, they're generally a requirement that it is distributed back out to its members pro rata based on the amount of business that a co-op does with those members. And it can be in cash and it can be in equity. And we have some slides that talk about both. But when you talk about delivering fruit that a grower is, that you're raising, that grower definitely wants to get the best price. If they're not going to get the best price for what they're delivering to the co-op, they'll probably go somewhere else. And so you want to be able to offer that best price, but still potentially hold some of it back to fund operations. How does co-op do that? So we'll talk about all of these things.
Can I just add a couple things, Josh? One is raising capital in a co-op is harder in many respects than it is in other business models. And I think that's one of the reasons that you don't see it, you don't see this model more broadly, because you can only really get, with some exceptions, which we'll talk about, capital from members. And members in a co-op don't always have a lot of money, and you got a small pool of people to get money from. And I also want to mention that you mentioned, I don't know, Ming Wei has a question here. Any thoughts on crypto financing for co-ops? So Josh, you already mentioned that briefly, but let's make sure we talk about that somewhere along the line here. You've got some experience with that.
Well, the co-ops that I work with aren't specifically raising capital through cryptocurrency. They were pretty unique. I haven't worked with any that are specifically being funded through cryptocurrency. I have worked with co-ops that are marketing and selling their patrons' artwork and being paid in cryptocurrency, but it is, it's essentially the dollar equivalent of whatever you're receiving being distributed out of the co-op. So at some point it's getting turned back into cash. I don't have a ton of experience in dealing with cryptocurrency, and that's something that's super new to all different business types. So I don't have a good answer for you on that.
Yeah, and I'll just add to that. I think cryptocurrency is a very, very new. There's not a lot of, I think there's some skepticism about it with a lot of people. It's not clear what kind of regulatory thing you're going to have and all that. So I would say, you know, the idea of getting it from cryptocurrency, getting funding from or using that for funding is probably going to be fairly hard until it gets to be a little more mainstream.
Sure.
If
somebody wants to give you Bitcoin or Ethereum or whatever to help fund your operations, so but you're going to turn that to cash to get to use it. So I consider it somebody making a stock donation similarly. Like you still have to turn whatever they're giving you into cash to be able to use it.
Yeah, I see Carolyn adds crypto's too risky, and my gut reaction is now at this point in time, focusing your fundraising on using crypto is probably a bit of a long shot. Maybe after the systems get better in place and everything, it'll be a different story.
I just wanted to touch on another question from Mingwei is about metrics and measurements for equity. And she's asking, what about hours and land? And I just wanted to chime in that, you know, typically equity is capital, financial capital, you know, putting in money to help start the co-op. In some cases, you can use other units. In our worker co-op, not the Hawai'i Ulu co-op, but our farm is a worker co-op called Malakalu'ulu. And in that co-op, it is sweat equity put in through hours. So I think you can get a bit creative, but traditionally we're talking about putting in financial capital to help start the business. So I just wanted to clarify.
Yeah, absolutely right about that. And thank you, Donna.
So what you guys are looking at right now is 6 different sources of capital that don't require a co-op to go out to a bank. This first one, so an initial capital stock purchase, I've got an example in a couple of slides of a base capital plan. The idea here is that to gain membership into a co-op, you have to buy in. And most cooperatives, most or all cooperatives are going to have a membership fee that you need to pay to fill out an application to be a member. This would be above and beyond the normal membership fee, where for your 1 share of stock in the co-op, you have to contribute X thousand dollars of base capital. And the idea behind base capital is that everybody in the co-op has the same base capital requirement, and your contribution or distribution out of the co-op that keeps your base capital on par with everyone else is reflective of the amount of business that you do with the co-op. So base capital could be a minimum amount of capital that the co-op wants to keep to be able to fund operations, to grow, to buy equipment, things like that. Base capital, if you were to pick a number at the beginning of the co-op's life, it's not static. It could be adjusted every year or every 5-10 years, whatever, depending on the cooperative's needs. We're going to look at a good working example of a base capital plan. I like these. It's really commonly used in agriculture, and the way money gets held back or contributed to the co-op to keep your base capital at its minimum can be done in a few different ways, either from direct payments from growers or holding back pieces of patronage dividends that we'll talk about in detail. Anyway, I like base capital plans a lot. I like the idea of it, it's said that it can be complicated to track and to set up, but I think that's what the board hires good accountants for, Don. And then patronage refunds. The idea behind a patronage refund is that if the co-ops are supposed to operate at cost, so it's providing a service to its members. It has to charge you to be able to cover operations and overhead, but at the end of your reporting period, when there is net patronage income left over, the co-op has an obligation to return those profits to its members pro rata based on the amount of business that each separate member did with the cooperative. There's a few different ways to issue patronage refunds. We're going to go through them. Per PIM and per PIC is probably a foreign term to everybody, unless you spend a lot of time working in co-ops. Per PIM stands for per unit retained paid in money. And that's a pretty complicated term, but what it means is that the co-op's going to hold back an amount of money per unit of whatever it is that you're delivering to the co-op to help fund its operations, and then eventually return that retained to you in the form of cash or in the form of a certificate of equity that would eventually be redeemable for cash. This is a way for the co-op to hold back money during its fiscal period from current operations to fund current operations. Per PIM is per unit retain is used widely across all marketing co-ops that I work with on the West Coast, and sorry, in the United States. This next one, retention of unallocated reserves. Unallocated reserves is a co-op's non-patronage income. So co-ops will earn income from business they do with their patrons, and if they have excess capacity, can open up their co-op to doing business with non-patrons. Patronage income is required to be returned to your members. Non-patronage business is gold. That is if a co-op has excess capacity, it should be using its facility and its staff to generate non-patronage business. That to me is free money to the co-op. And then preferred stock is one way for a co-op to raise money from members and from outside of the co-op. There are some caveats and obligations that come to preferred stock, that come with raising preferred stock, that we'll talk about more. And then
I'll just mention this, that having pure equity investors in a co-op who are not members and not doing business with the co-op creates problems with the tax neutral status of the co-op, and it kind of destroys that status. Preferred stock does not, but it gets to be treated as equity on the balance sheet. And most people who evaluate, it's like if you're going to a lender or whatever, who evaluate a balance sheet will give you equity credit for preferred stock, but maybe not 100% equity credit. But it's a way that a lot of co-ops have used to take in investment without destroying their cooperative status.
There are some co-ops out there that issue preferred stock some will issue preferred stock in lieu of patronage dividends.
Yes. Yep.
You're eligible for a patronage dividend. They distribute it to you, but it's as if you gave it right back in exchange for preferred stock. And as long as you're willing to allow the co-op to hang on to your cash and as in the form of preferred stock, they will pay you a return. But also, if you're holding that preferred stock and choose to, it is easily redeemable for cash. So it's a way for the co-op to raise capital, but it's also very liquid to whoever holds it. That's not always the case with preferred stock. It's not always that easy to turn into cash, but that is one real useful way that some co-ops choose to issue it. And then this last one, subordinated debt. This is, it's not equity in the co-op, but it is, it's debt held by a member or an outside investor that has position over the other liabilities of the co-op. Dave's going to talk a bit about subordinated debt at the end.
Yeah, so subordinated debt, a lot of co-ops use this, especially natural foods co-ops, consumer co-ops, as a method to raise money by getting cash from members that is not, it's not equity on the balance sheet, it's debt on the balance sheet, but it's like equity and other like vendors, commercial lenders, co-op lenders, whatever will treat that as a positive equity for a co-op when they're evaluating the credit worthiness of it.
And one more question from Mingwei I just wanted to touch on. She had a question about taxation, and I believe Josh is going to get into the details of taxation in a minute.
He is, yep.
But I just wanted to clarify what Dave was saying about tax a moment ago, was just that if you bring in non-member equity holders, not through preferred tax, but through like common stock, for example, then that can jeopardize your tax status as a co-op. So Josh will explain some of the benefits of co-op tax law. And basically, if you bring on non-members as shareholders, then you could jeopardize that favorable tax law. I believe that's what Dave meant.
Exactly, right. Thank you.
All right, so let's talk about a little bit about base capital. It's a means to accumulate equity in the co-op, and it's a great reflection of commitment by individual members to help grow the co-op. Advantages of a base capital plan is linking the member investment directly to use, meaning if I have 5 acres and you have 100, we're gonna have base capital balances that are proportional to our use in the co-op. It's this systematic adjustment of capital requirements we're gonna see in this next slide. I have an example, but basically what it means is our co-op's base capital is going to fluctuate year to year. And you're either going to contribute more or receive a refund year to year to keep your base capital at that threshold. Some disadvantages of a base capital plan, it doesn't work well if there's constant and large member turnover. It's inconvenient to management. It's an administrative burden to constantly be returning checks or trying to raise base capital through new members, because you're going to see in this example that there could be occasions where it's prohibitively expensive for a new member to get in if a co-op has a base capital plan. Okay, so in my example, can you guys see my arrow too on my mouse?
Yes.
Okay, so in my example, this co-op is going to have a base capital plan where they want to raise and keep $100,000 of working capital, and they are going to raise it through their 20 members. So in year 1, all of our 20 members, no one's done business with the co-op yet. Everyone's going to contribute $5,000. So at the end of year 1, we've raised our $100, and every individual member has contributed $5. And for whatever reason, management and the board in year 2 has raised that working capital threshold to $150,000. So we need to raise 50 more. That's going to come from our 20 members, and so everyone will need to contribute $2,500. A few minutes ago, I mentioned that you would contribute to a base capital plan proportional to your use of the co-op. This model is just assuming that everybody's even. Everybody's on the same 5-acre plot. Everybody has the same amount, the same pounds produced every year that they're going to donate, contribute to the co-op. So our base capital requirements are all going to be equal. I know that's not true. It's going to fluctuate. So there might be one member that contributes $7,000 and one member that contributes $3,000. Your base capital is going to be proportional to your use. So everybody contributes $2,500, and at the beginning of year 2 is when this would occur. We have $150,000 to cover working capital for the year. This means that everybody has contributed $7,500 to the co-op. In year 3, it goes up $200,000, so we go through the same exercise. And in year 4, we've decided we don't need that much cash. we've reduced the working capital requirement to $110,000. Now we've got too much cash. We've lowered the bar for our base capital requirement and everyone has contributed too much. And so that means we're going to refund $90,000 of equity to our members to get that base capital threshold down to what it needs to be. So everybody in this example would get a refund that reduced their base capital requirement to this $5,500 per member. So that bar is constantly being raised and lowered to meet the co-op's needs. And in my example, I'm only talking about working capital, but this bar could be raised because the co-op wants to buy new machinery, wants to expand, whatever it is that they're doing. Base capital plan is very open to its uses, how management and the board would direct it. I am not trying to keep up on all these questions. If somebody,
there's
one related
Josh,
to base capital.
if I can just jump in for the is it Jokanan?
Yeah, Yokanan.
Yokanan, sorry to mispronounce it.
Yeah.
That's a very good question. I'm just going to give an example, but there have been a number. I'm going to use this example, the ethanol industry. I think you're probably all familiar with that. It's mostly a Midwestern U.S. thing, but it was turning corn into ethanol or into fuel, and there was a lot of interest among farmers in it. Farmers would put money in before anyone else, would put money into building ethanol plants, and they used the cooperative model for a variety of reasons. One was there's a securities exemption when you sell shares of stock in a co-op, and the other is no one else would put money in except farmers. Well, so they ended up sometimes, a community of farmers or an area would start trying to develop an ethanol plant, pick a site. There was always usually a lot of enthusiasm about that, but the farmers themselves didn't. It was an expensive undertaking, a huge capital project, many millions of dollars. And so they would sometimes try to bring in investment from like the local bankers and the local business people who were interested in seeing this happen. And they would use a LLC model, like you suggested, and the co-op would own, let's say, 70%, and the farmers would deliver corn and get all their profits back on a tax neutral basis. But the bankers would put in money into directly into the LLC and just own a percentage of profits. And it came back, that was tax neutral to them because it was a partnership. So that's a model that was used a lot in that circumstance. And it seems like if you have an opportunity and you're trying to get farmers, for example, to put the money in, and they just don't have enough money, that is a model to get outside capital into the facility.
I have some co-ops that have joint ventures that are co-owned by other non-co-op entities that provide some supplemental service or secondary use of whatever the good is that the co-op is selling. And they'll share in the cost of equipment. They will share in a distribution channel, whatever it might be. But yes, you can do that. It's very common. Keep going. Okay, patronage refunds. A patronage dividend, the Internal Revenue Code has a long, not too complicated definition of what a patronage dividend is. It's an amount paid by a co-op to a patron based on the quantity or value of business done with the co-op under a pre-existing legal obligation determined by net margins on business with all patrons. What this means is that when you become a member or sign a patronage agreement with a co-op, you're agreeing that the co-op is agreeing with you that it has an obligation to return any profits from selling whatever it markets or sells to you or for you on your behalf, to you pro rata based on the amount of business that you do with the co-op. And when a co-op gets to the end of its fiscal period and has net income to distribute, it will issue a patronage dividend, either in the form of qualified or non-qualified equity. And that designation of qualified or non-qualified equity affects the tax treatment to the co-op and to its patron. The great tax benefit that a co-op provides is that it eliminates one of the layers of tax that a corporation is and its shareholders are going to be subject to. So in a traditional C Corp model, a C corporation has net earnings, it will pay tax on those earnings. And then if it wants to distribute those earnings out to its shareholders, it does that in the form of a corporate dividend. It's already paid tax on the income. And when it issues a dividend to its shareholders, the shareholders are going to pay tax on the dividend. So it's good. So those earnings are being taxed twice. When a co-op issues a patronage dividend, depending on how it classifies that dividend, either the co-op is immediately, the co-op is going to pay tax on day one. Well, let me step back. If a co-op issues a qualified patronage dividend, the co-op gets to distribute its profits to its members, gets a deduction for that distribution, and effectively won't pay income tax on it. And then its members who received that qualified patronage dividend will pay tax on those earnings. That is the treatment for a qualified patronage dividend. I think I might be getting ahead of myself. I'm like a slide away from this. Yeah, it's okay. We can't work that. All right, I'm kind of jumping around. So in order for a co-op to issue either type of a patronage dividend, it has to meet some requirements. It needs to be distributed or allocated to patrons within 8.5 months of your fiscal year end. That is your tax year end. If allocated within that 8.5 month period, the qualified or non-qualified designation of that dividend will determine its tax treatment in the year that it's allocated and also in the year that it's redeemed. And I'm going to talk about redemption cycles. In order for it to be a qualified patronage dividend, at least 20% of the dividend has to be paid in cash. The rest can be issued to the patrons in the form of allocated equity. So in year one, when a co-op has net earnings and issues a qualified patronage dividend, let's pretend like it's $100 of net income. 20% will be allocated in cash, and the other 80%, $80 will be allocated in the form of equity. The co-op gets a subtraction for $100, and the members have $100 of income to pay tax on, even though they only receive $20 in cash. They're paying tax on the cash and the equity allocated to them. The purpose for this 20% requirement was decided a long time ago, and is intended to put cash into the hands of your patrons so that they can pay the tax liability on the cash and equity. Yeah, it's kind of what I was just talking about. So some portion of this is going to go in cash, and the rest of it in the form of equity is retained by the co-op. It's a credit to the patron's equity account and is issued to them in the form of a written notice of allocation. So literally before if you're a December year end, the co-op has until September 15th of the following year to issue a qualified written notice of allocation or a non-qualified written notice of allocation, which tells the patron how much of that closed fiscal year earnings are attributable to the business that they did with the co-op. I talked about tax treatment of qualified patronage dividends. Non-qualified patronage dividends issued by the co-op is just a way for the co-op to defer the tax liability of an allocation to its patrons. So if a co-op issues non-qualified equity, that same $100 that we were talking about, co-op issues that piece of paper to its patrons, they have their share of the $100 dividend. But in year one, the co-op does not get a deduction. The co-op will pay tax on that $100 and the recipient will not. And basically you're holding on to a piece of paper that is a future promise of the co-op to revolve your share of non-qualified equity to. And so co-ops will have a revolvement schedule for their qualified and non-qualified equity that says we're going to pay this to you X years from now. It's basically your reinvestment into the co-op. So this reinvestment of qualified or non-qualified equity is our mechanism for the co-op to raise cash from its patrons' operations. Say we're on.
I'll just mention, Josh, that this most of the 20% is the minimum to get this tax exemption. But most co-ops are going to be, if it's business to business or even business to individual, are we going to be paying more than 20% because the tax burden for the member is usually more than 20%.
I would say in my client base, I would say more than half of them issue 20% in cash.
Oh, is that right? So
yeah, in the other half, it's a total mix. Some will change that percentage year to year. Some will pay like a very high percentage, like 50%. And then that other 50% get retained for their revolve schedule. There's a wide variety I see across our clients of that percentage being paid in cash. And I'll say it fluctuated a lot when Tax Cuts and Jobs Act happened, and also when COVID happened.
right.
Upset, historically issued 20%, said, okay, we're going to do 80 or 100, and we're going to try and get cashed out into our patrons' hands. So that point, this is a great point. The 20% is a statutory minimum, but you can do whatever you want above 20% to retain this qualified allocation status. I will say for co-ops that use it as a tax planning tool, this 20% requirement is very convenient because your tax rate on unallocated earnings or non-qualified allocations is 21%. So like, do we pay the federal government 21% or do we pay our patron 20 to get the
Right.
It's a no-brainer. 20% is going out in cash.
That's a good point. My comment about that was based on before they lowered the corporate tax rate to 21%.
Right. And as soon as the corporate tax rate went down, this is probably more complicated than we want to be. When the corporate tax rate was reduced to 21%, a lot of co-ops flipped to issuing non-qualified equity. Why not let the co-op pay the tax while we sit here and use the capital? We'll allocate it out some later date. Maybe tax rates go up. We have a lot to cover. I talked about taxes. This is a revolve schedule, and I did it out to 10 years, but really only need to look at like the first 5. So in this model, in year 1, the co-op has $1 million in net income and wants to issue a qualified patronage dividend. 20% is going to go out in cash, so $200,000. And then the other 80%, $800,000 is going to be retained as qualified patrons' equity. So we had $1 million in net income. The co-op has an obligation to return its profits to its patrons, but $800,000 of it gets to be retained for working capital, whatever the co-op needs to use it for. In this particular example, the co-op has a 5-year revolve schedule. And that means 5 years from year 1, we're going to start paying out this qualified equity. This is totally up to the co-op and the board too. You can get creative for how these work, but this $800,000 won't start to get redeemed and paid out in cash until year 6. and then we're going to pay it out evenly over the following 5 years. So if we raised $800,000, we got to use it for almost for a decade. So if you go through this model, through this 10-year period, the co-op, through issuing qualified patrons equity, is able to retain 800,000 in the first year, 1.6 million through the end of the second, 2.6, and it increases. And if you were to take this model out through year 15, this cumulative net cash flow would be reduced to 0. So the co-op's using patrons' money, and it has to keep making money and raising money through its life, but it's going to use it and then return it to its patrons over a period of time. This 5 through 10 year is just an example. If I have 30 co-op clients, there's 30 different models. But you see that through issuing qualified equity, the co-op's able to raise a lot of money just through the patrons. Okay, the per unit retain is the idea that we're going to charge. I'm going to skip that slide because we're going to run out of time. Per unit retain is the idea that the co-op is going to charge its patron a dollar amount based on a per unit amount. So if I deliver 100 pounds of fruit and I'm going to pay the patron $2 a pound, that's $200 for their delivery. We're going to subtract out a packing charge because we have to pack their fruit. We're going to subtract out a storage charge because we have to store it until we can market and sell it. And we're going to pay the patron $190 for what they delivered. Hopefully that $10 was enough to cover operations. The idea of a retain is that we're going to charge the patron some amount over what we know our costs are to store and process that fruit, in case it's not enough to cover working capital. Things come up, maybe we get a bad price for the fruit that we're selling this year and the $10 wasn't enough. We don't want to go back to our patrons and say, we overpaid you, we need you to cut a check. And I have seen that happen. So to hold back this $10, make sure that we've covered operations, and at the end of the period, that per unit retain gets paid in money. That's our PERPIM. Per unit retain paid in money is generally paid once we know the pool of fruit that we're selling was sold for a high enough price. But per unit retain is very common in marketing cooperatives to ensure that overhead is covered. I've seen a retain charged for other things than working capital. I've seen building fund retains. I've seen rainy day retains that don't have a purpose other than to make sure that we have capital for next year. There's lots of things that co-ops can do with that retain. I talked about non-patronage business. If your co-op has more capacity than the business it's able to do with its patrons, then you have idle assets, and idle assets are very expensive. So it should be management's goal to go out and find non-patronage business. Your non-patronage earnings cannot be distributed to patrons the same way qualified and non-qualified patronage dividends can. It is essentially corporate earnings and could be distributed in the form of the C Corp dividend. Otherwise, if it's going to stay in the co-op, it's unallocated reserves and it is free for management to do whatever they want with. If you have idle assets, you should figure out how to use them. Do you want to talk about the last 2 slides, Dave?
Absolutely. Thanks so much, Josh. Let's see. Why don't you go to the next one?
Sure.
Yeah, there you go. So raising money, there's been a few questions about raising money here. When you're raising money for a co-op or for any business, there's these securities laws that apply, and they basically say you can't do general sales or broad solicitation of investors in an entity without doing SEC compliance. And SEC compliance is so expensive, it's just pretty much a non-starter for a startup business, unless there's a lot of funding behind it. So co-ops have some special rules that apply to that. And basically, there was a litigation that went to the US Supreme Court in the early 70s that established the principle that if you're buying a membership interest in a co-op, it is not a security subject to those securities laws. You can actually advertise to sell, membership interests in a co-op. You can do it without any kind of registration with the SEC. And most states, including Hawaii, have their own exceptions. So in Hawaii, you can raise money from members, like in a retail co-op, without having by selling preferred or just common shares, without having to register or worry about securities. I shouldn't say you don't have to worry about securities. You don't want to do fraud, but you don't have to do compliance with all these rules that make it very difficult to raise money unless you have a lot of money to start with. So that's patronage capital. When Josh was talking about the profits being allocated back to the members in cash and in other, equity. That is clearly not a security. You don't have to worry about securities rules with regard to that. I mentioned the 521 exemption here. There's a special rule that's kind of odd that says if it's an agriculture co-op and you organize it under a tax law or a tax section, it's section 521 of the tax law, then it is exempt from registration under federal securities laws. It is not have much application. Theoretically could, though, if you're forming a co-op and trying to raise money to like build a processing plant for agriculture products. 12G is if you have a corporation that gets more than a certain number of shares, I think it's shareholders, 500 right now, then you can find yourself, even if you didn't do a broad sale of securities, having to do securities, SEC and securities filings. But there's an exemption from that for cooperatives that is, prevents a co-op who gets big and has a lot of members from having to do SEC filings. And then the blue sky, I've already mentioned this, securities laws. How many of you have you dealt with this with your co-ops and trying to figure out how to raise money and what kind of rules you have there? Every state has their own securities laws, and so does Hawaii. And Hawaii has some exemptions that apply to co-ops. They're not perfect, but they usually protect you when you're selling, shares in a co-op just to residents of Hawaii. So you can go to the next slide, Josh. We have 5 minutes left, so I'm going to be very short on this slide. One of the other kind of unique regulatory aspects of a co-op is that for an agriculture co-op, and this only applies to an agriculture co-op, so a co-op of producers of agriculture co-ops that are, or of agriculture products that are selling those products collectively, you're protected from antitrust laws. So you don't have to worry about, theoretically, half the farmers in the United States could get together and form a co-op and dominate the market pretty heavy, but not have antitrust, but have an exemption from the antitrust laws. I've heard, I'm not sure if this is happening or not, but I've heard that the Biden administration is actually looking at whether it's the Justice Department whether they should try to eliminate or limit that co-op exemption for big co-ops.
That would really speed things up.
Yeah. So I don't know, we're kind of at the end of the rope here. Should we invite questions, Josh?
Yeah.
We've had a few. We kind of stifled them for a while.
I did see a question that that I get a lot, and I see farmers' income tax returns done incorrectly all the time who are members of co-ops. The question is, so we get taxed on our equity? Yes, it depends. So when a co-op issues a qualified patronage dividend, and you get your letter that says you've been allocated $100, and they give you a check for $20, you're going to pay tax on the $100. And then depending on that co-op's equity cycle, telling it's 5 years. 5 years from now, they send you your check for $80. You have already paid tax on the 80. It's return of capital. It's free cash to you. So in a situation where a qualified patronage dividend is issued, you pay tax up front. And it's as if the co-op had written you a check for $100, you paid tax on it, and then you wrote a check back to the co-op for $80. It's your investment in the co-op's future. Good question. And it is frequently done wrong.
Yeah, that is a good question. And it all kind of depends on the circumstances, doesn't it? Like you said, sometimes it's better to have the co-op pay the tax than not the member, and sometimes it's better to do it the other way around.
Yeah, as soon as the corporate tax rate got decreased to 21%, most co-ops that understand the tax impact of qualified versus non-qualified equity would stick to the cash portion that they were always issuing. So if they were doing 20%, you get your $20. And then they would issue, so you get $20 of cash, and if it's cash, it's qualified and you pay tax on it. And then the $80 they would issue as non-qualified equity. So you get two different classifications of equity. And that means that the co-op in the year it's issued would pay the tax on the 80 for you. And 5 years later, when they pay the 80, you could pay tax on it. And that makes perfectly provable mathematical sense when a co-op's tax rate is 21%, and we can assume that all the patrons of a co-op, us individuals, have higher tax rates than 21%.
Thank you.
It is 6 o'clock. And so if folks need to leave, feel free to do so. I think Dave and Josh, if you guys have a few minutes, could we stay on for like another 5 minutes and see if there's any more?
Absolutely.
Yeah, I'm fine.
Okay, great. Thank you. And for those that do have to leave, thanks again for joining. And we'll send a follow-up email with a link where you can find all the recordings from this webinar series. Any other questions? I have some. So I wanted to clarify what you just said, Josh. I was under the impression that the qualified written notice of allocation was always the members pay all, even if only 20% or a percentage of that is distributed in cash and the rest is kept on the books. But it sounds like in some cases the co-op actually would pay tax on the amount reserved as equity. Can you clarify?
Yeah, in order for the co-op to pay tax in the year that it's issued, the designation for that allocation would be non-qualified.
Okay.
A non-qualified written notice of allocation. So
okay.
The cash piece in that case is qualified.
Okay.
Cash taxable. So you would need to designate, you need to pick what the equity allocation is going to be.
Okay.
Whether it's qualified or non-qualified.
So there can be a qualified and non-qualified written notice of allocation in the same tax year.
Yep.
Could be.
Got it.
Yep. And it becomes administratively more difficult to track.
Sure.
HUC doesn't have a 1,000 members To me, it's a spreadsheet.
Yeah, that makes sense.
It's a spreadsheet for the 1,000-member co-ops too, but they tend to complain.
Yeah. And you're right,
A lot of letters.
Mingwei, you're right. There's some analogies here to nonprofits. Nonprofits or tax exempt entities, charities can have taxable income if they're doing, things outside their scope.
Yeah, and I think sometimes people assume that co-ops are not-for-profit entities. All of the ag-focused cooperatives that we're talking about, supply and marketing co-ops, they're referred to as non-exempt cooperatives. There are exempt cooperatives, but not many anymore, so we're not going to talk about them. But these marketing co-ops like HUC, they're non-exempt cooperatives. They're going to pay tax on unallocated earnings.
Well, you have in Hawaii, you have one electric co-op getting started. And isn't there an electric co-op on Kauai? I think there is, yeah. And they're kind of odd. They have a special tax status that most of them use. It's called Section 501 or 512, Section 512, 501c12. And they so they're filing tax returns that are on a 990, not on a 1026 or whatever it is that corporations or co-ops that are taxable file their tax returns on. But that's pretty unique. There's not a lot of, there are some co-ops that have special tax exemptions that are broader than what Josh here described under subchapter T, but you're probably not going to run into that a lot.
Yeah, aren't those for like utility, water, and stuff like that?
Yep.
The C12s.
Yes, it's rural, and it's defined as rural. Rural C12 or rural water, rural electric. Maybe there's some other rural telephone. There are a lot of rural telephones in the continental United States, but a lot of them are going away right now. They're getting bought up by non-co-ops.
Same is true for the marketing co-op world and supply co-op world. Not that they're going away, but to be competitive, there's a ton of consolidation.
That's right.
I have another question on the base capital plan. That is usually in preferred stock, right? There'll be like a small amount of common stock for the voting share, and then it can
Not necessarily. Base capital will be its own class of equity. If you issue preferred stock, then there's a good chance you're going to be required to pay a return. I have seen preferred stock get issued with the 0% return, but it's not common. So if you're issuing preferred stock, you probably have to pay interest.
It is that it's all about nomenclature. In some parts of the United States for natural foods co-ops, which are consumer-owned co-ops, they issue what they call Class C shares to represent the patronage refund, the non-cash patronage refund, and they call it Class C shares, or maybe Class B shares. And that's very common, but it's the same thing. It just has a different name on it.
So in those cases, there would also be common stock, right? In all cases, there's also going to need to be common stock because that's the voting shares, right?
So in a consumer co-op, like a food co-op, most of them will have a nominal amount, maybe $100 or $200 to become a member, and that's a share of common stock. Mm-hmm. And then the additional stock additional share of the profits that is withheld is allocated in a member's name. A lot of them issue B stock. And usually, you know, some people don't use the co-op very much, so it might take them a few years of activity to earn a share of B stock. So they usually issue partial shares of B stock. But at the end of the day, it's exactly the same as calling it patronage equity, just a different term for the same thing.
Got it. Thank you. My last question was, sorry, there seems to be a little echo. So I'm really interested in the concept of the per unit retain. It's something that we haven't done before. And the way you broke it out in the sample spreadsheet, Josh, where there was like a packing charge, a shipping charge, and then a working capital per unit retain. And then you showed it being, you know, refunded in 5 years' time over the course of 5 years. My question is, I guess, is it common for there to be like a separate amount of, you know, a portion of the unit separated out like that? So you actually break it down for members so they can see that, you know, 10% is going to this and 5% is going to this. And then,
Yeah.
And then
So in that, yeah, I'm sorry. In that
okay.
example, and in other marketing co-op grower statements, they'll have these, like the pack charge and storage charge, those are known. It's like, we know that that's going to cost us X dollars per unit. We charge it to our members, to our non-patrons that come in and deliver goods to us. We know that's the cost to process X units of whatever you're delivering. It's not going to be returned to you. That retained charge gets classified separately. Then in that example, it was a working capital retained charge. But if it's, well, any type of retained charge, that is basically an amount set aside attributable to a member to make sure that we can cover overhead. And if we did, you get your money back. So yes, it is explicit on a grower statement. You'll see all the other charges. If say in the example where a retain was not charged and you get to the end of the period, it just means that your co-op is going to have more net income than the co-op that charges the retain. Your patronage dividend is going to be bigger. Those profits are still going to get returned, but that amount isn't known until the end of the period. And so you're banking on your co-op having very tight control of costs. You know, if you're not worried about the weather ruining your crop, it might not be as dangerous as some co-ops that we work with that where price fluctuates pretty wildly, not wildly, but enough to, you know, a couple cents a pound could mean you're in a loss position for the year. And so a retain will, the most simple use is a working capital buffer.
And the
Complicate
charge is not returned.
Go ahead, say it again.
Sorry, the packing and shipping charge is not returned. It just shows up as like a fee, basically.
It is a fee. I mean, you have rent and utility and employees to pay. So you know that you're going to spend that money. You probably have a pretty good idea of what it costs you to process 1 pound of Hulu. It's the other foreseen costs. It's the other overhead costs that aren't directly tied to your warehouse that you need to make sure that you cover.
Is the philosophy to show the full price and then deduct from there instead of just offering a lower price to begin with? Something about the perspective of the member that it seems like they're getting a bigger price and they're just sharing in the costs?
You're not so affected by this because there aren't a bunch of packing houses on your island, but pretend like you're in California and you're a citrus packing house, you need to be paying the best price compared to your competitors, right? And so you show a gross pound per pound price. They know what they're getting. They know what they're being charged for and what they're getting credit for.
Mm-hmm.
I'm not certain what the fair market price is, you know, for a pound of what you're selling.
Mm-hmm.
So yeah, like what I'm describing is already built into the price that you're paying. It is more transparent.
I see. Got it. Okay.
I'm not sure what the fair market price is, but I ordered some and we had it. It was well worth it.
Thanks, Dave.
To prepare it.
And it got all the way to Minnesota without rotting. So
Yeah.
yeah.
Flour, or did you buy breadfruit?
Well, we bought several things. There was like a package of several things in there. Breadfruit. I can't remember all the things that were in there.
Yeah.
3 or 4.
Frozen, different frozen
Yeah.
starches. Are there any other questions? All right. Well, thank you again so much, Dave and Josh. That was awesome.
Yeah, Josh, good. Very well done, Josh.
Thanks, Dave. You too.
Yeah, thank you guys so much.
And
It's
if you
complicated
guys,
stuff. You all have a good evening.
thank you, Dave. And if you guys have further questions, feel free to contact the co-op or the Kohala Center, and we can try to pass it along to Dave and Josh.
Sounds good.
Thanks, everybody.
Thanks, you guys.
Aloha.